Everyone, Couch Investor back to another video for today. So you probably clicked on this video wondering why this person is now making a video about 100 baggers, or more importantly, the science behind 100 baggers when the market is down the drain. Well, it's because history tells us that if you really want to find the multi-bagger, the 10x, the 100x, the 100,000x, yes, because those exist actually. We've seen it with the Apple video yesterday. Apple, since its IPO, it returns over 85,000%. I'll repeat that, 85,000%. Now, obviously, to get those returns, you need to buy it, well, back then in the 1980s and hold it for over 40 years, which is something not a lot of people can do or are willing to do, which is also one of the main reasons why Warren Buffett is regarded as the most successful investors of all time. It's not because his CAGR was the best. Actually, his CAGR was not the best. There are actually people that had a better CAGR than him. But the only difference between those people and Warren Buffett is that, well, he started extremely young and stayed in the market until today. And that's why his returns are so big. We all seen the graphs, right? We all seen the graph that when he hit, I believe, 51, 52 years old or something like that, that's when the billions started to accumulate extremely fast. Now, besides that, Berkshire Hathaway is also a holding company, right? In that holding company, he has insurance companies, and he basically borrowed or took that insurance money, because you pay the premiums first and then you pay the claims. So between the time somebody pays a premium and they receive or they make a claim, they can use that money to invest. No, it's basically free money. And even if it wasn't free, even if he had to pay a claim later on, it was still extremely, extremely low. So he was investing with money that he got basically for free. And since he has done that from the start and still continue to do that over and over and over each and every year. Yes, there are some years where they stopped or maybe they slowed down extremely, but still you have to be a long time in the market to beat returns of Berkshire Hathaways. And unfortunately, those are things that, well, a lot of people, most people cannot do and are unwilling to do. So just wanted to point that out. Also, two important books most of you should probably read. One of them called The Psychology of Money by Morgan Housel, and the other one is called 100 Baggers by Christopher Meyer, right here. Extremely easy books to read, and they give you a lot of insight. Obviously, the 100 Baggers one, some things are going to pop up on the screen during this video, because this is a book talking about 100 baggers, the history of them, how to find them. So I'm going to talk a lot about that. And then the psychology of money talks about, well, the psychology of money, basically the psychology, people, how they react when they make a lot of money, how they react when they lose a lot of money, and why, in my opinion, and in Morgan Housel's opinion as well, learning and studying people is extremely important in investing. Because at the end of the day, everybody has access to the same information out there, right? We all get the earnings numbers. We go on the internet, we can all look it up. But some people can read other people, humans, better than others, and they can predict what might happen next. You might predict much better what might happen when somebody loses 40% of his portfolio because, well, you already experienced it. If you never experience a recession, if you never experience high inflation, if you never experience losing all your money, you will never know how others react. If you did experience that, you will probably know much better than someone else how the majority of people might react, and you might act in advance. So, two great books, very easy to read and not that long. Now, let's go into a couple of topics that I want to cover in this video that were also covered in one of those books. The first one is the coffee can portfolio. So, this comes from the book, The Biggest Hurdle to Making 100 Times Your Money. So the reason the author spends a lot of time here at the beginning showing you the power of long-term investing is because it is really important. Again, going back to my point I made with Warren Buffett, the longer you stay in the market, the better the results. It doesn't really matter about how high your CAGR is. Somebody has a CAGR of 66% and you have a CAGR of 20%, but he stays in the market for 5 years and you stay in it for 40 years, you will obviously be better off. Now, obviously it's easier said than done, but I hope you get the point here. Now, the biggest hurdle to making 100 times your money in a stock, or even just tripling it, may be the ability to stomach the ups and downs and hold on. This is why I put both these books in this video, Psychology of Money and 100 Baggers, because they go well hand in hand. And this is also the coffee can portfolio solution. So the coffee can is a foolproof way to inoculate yourself against those sickening ups and downs. He continues here by saying, I'm sure you've seen some big moves in the overall market in your time. The urge to grab a quick gain or let go of a loser is strong. So you might ask, what's the coffee can portfolio strategy? Well, it's basically buying companies. Obviously, the more companies you buy, the more chance you have that you will pick great winners that will outperform the couple of losers that you have in that portfolio. Coffee can, you open that, you put some stuff in, you close it, and you put it in your closet, and then 30 years from now, you open it again and you see what happens with your holdings. That's basically the coffee can portfolio. Now, on to the next point. How many years does it take to get 100x returns at different rates? So if you want to visualize that, so basically 5 years is a compounding rate of 94%, extremely rare. But let's take a more, let's say, normal or realistic one, right? 20 years, 25% for 20 years. That's pretty realistic if you are picking out a very young, small company that is growing extremely fast, has a high return on equity. So 20 years, 25%. Let's say you even look out longer, 40 years, 14%, and you get 100x returns. Now, most people that are watching my videos are already in your 20s and 30s, which means 40 years right now, you'll be in your 60s and 70s, which again, mentally, it's extremely difficult to comprehend this because what? I'm only gonna 100x my returns when I'm 70 years old. Who even knows if I'll be here when I'm 70 years old? So basically look at this picture and visualize how old you might be when you get that 100x. And again, very important to note that if you're looking for that 100x, but it never comes, that does not mean that you haven't caught a 20x, a 50x, a 60x, or maybe a 10 bagger. 10x your money is still pretty good, right? And obviously 10xing your money happens much faster than 100x. Obviously it depends on the company, but you get the point. Next up is the total 100 baggers by year range. So 1 to 15 years, there are 60 of those. 16 to 30 years is the most, over 180. 31 to 45 is the second most, just between 100 and 120. And then 46 and 60 years, much, much less. So this basically shows you a bit more the optimistic side. You don't have to wait for 60 years or 50 years. You can even do it much less time. Now here are some of the fastest companies that have returned 100x times your investment. And some of them are, to be honest, nuts, right? Franklin Resources, years to 100x, 4.2 years. So imagine you put $1,000 in the stock, 4.2 years later you made 100 times your money. I mean, that's a pretty good deal, right? And some other names out there, Qualcomm, 7.3 years, Hasbro, 9.8, Monster Beverages. In the book, there's a great case study with that, 9.5 years as well, Home Depot, 9.7. But as you can see, sometimes you might catch that 100x extremely early, and well, you might retire early as well, because if you can wait 5 years, 5 to 10 years in this case for this list, you might retire extremely early. But important to note that in those 10 years, it might happen that the company or the stock does not perform well for a while. And that's usually when people jump ship. And those that stay on that ship get that 100x or that 10x or that 50x. Then almost at my last point here is a quote by Charlie Munger. So if a business earns 18% on capital over 20 to 30 years, even if you pay an expensive looking price, you'll end up with a fine result. Again, putting the emphasis here on long-term investing, 20 to 30 years. If the business manages to earn 18% on its capital for that long, it doesn't really matter if today you bought it at an expensive price. Eventually, you'll have great returns. Maybe not as great as, well, if the price was lower, if the valuations were lower. But again, it's about having those big returns. If you're looking for that 100x and at the end you only had a 50x, would you be sad or would you be extremely happy? I think most of us would be extremely happy. And our last point is the difference between ordinary public companies and ones that are operator owned, basically founder led. And this is the graph right here. On the left, you have the typical public company. So you have the agent management, basically quarterly earnings, compensation focused, flashy acquisitions. And then after that, only after that, you have below average return to investors or shareholders in this case. Then on the right, you have the owner operator, founder led. So in the middle, you have management and shareholders. Very important. It's the same category, management and shareholders. So you have personal wealth at risk because, well, he's the founder, he's heavily invested in his own companies. Then long-term profits, which leads to opportunistic acquisition, which leads to superior value creation and the virtuous feedback cycle here. But again, it's very important that it's management and shareholders together. Unlike on the left, where at the top you have the agent management and then at the bottom you have the below average returns to shareholders because they focused on quarterly earnings, flashy acquisitions, and compensation focused, and only then shareholder value. And so the science behind finding 100 baggers here is pretty simple yet also complicated. Patience, long-term horizon, be in the market for as long as you can, pick winners. Obviously, we cannot only pick winners, but make sure that your winners outperform your losers. Look for owner-operators, or in this case, founder-led companies. They statistically outperform non-founder-led companies. That's historically correct. And again, study people, because people make the market. Nobody else, right? People make the market, sentiment makes the market. We've seen that with analyst price targets, right? Price goes down, analyst downgrades. Price goes up, analyst upgrades. Sentiment changes, stock goes up, stock goes down. So that's why I picked out those two books. Again, The Psychology of Money, Morgan Housel, and The 100 Baggers from Christopher Meyer. So I hope you found this video interesting. If you have other great books that you've read with regards to 100 baggers, with regards to investing, do share them down in the comments below. Maybe I'll do a video. I actually did a shorts on the shorts channel, 3 shorts actually talking about the best books you have to read. Great books. Some of them may be a bit outdated, but still very good chapters in them. Make sure to check that out, but be sure to share yours down in the comments below. And if you enjoyed this type of videos, leave it a thumbs up. If you haven't subscribed to this channel, maybe hit that subscribe button, and I'll see you all in the next video. Bye bye.